Be greedy when others are fearful, a commonly used quote by Warren Buffett, and while 100% true to its core, it's a lot harder to put into practice than it seems. So today, I'm going to make your life easier. We're going to be diving into 3 simple economic factors, the fundamental, the macro, and the technical, to get a holistic picture and answer the question, should we be buying this dip or waiting for a deeper pullback? We're going to be looking at Goldman macroeconomic forecasts, earnings reports of some of the biggest names, as well as some of the latest charts to also help us answer that question. We're also going to be taking a look at plenty of historical, seasonal data to determine what normally happens after huge rallies in stocks, bonds, and yields, and the forward returns that we can expect. Should we stay bullish, or is this the end? We got a lot to talk about, so let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial market. My name is Chase. If you like this video, please subscribe. We're trying to get 10K in May. Hit that notification bell. Let's get into it. This is the daily heat map of the S&P 500. Guys, so what if you just do the eye test? We just look at this. What do you see? You see a lot of green, you see a lot of red. More green than yesterday. What does that tell you? Okay, breadth across the board is improving. And we definitely saw that in today's trade. We saw the RSP was pretty much flat. I think it was down 0.9% or 0.09% for the day. So across the market, fairly flat. We saw weakness in some of the mega caps, Tesla, Amazon, Apple, Microsoft, as well as semiconductors here, bar Nvidia. But there was some green in other mega caps. We're looking at Google and Meta. What's still concerning me though is this section here in staples. They were kind of green. Same with telecom services and then utilities. These very defensive sectors, part of the shut index. That is concerning. So the market is still posturing a tad bit defensive. However, financials continue to be green, and I think this was just led by financial earnings. I think the market is realizing, hey, these earnings were really, really good. I think Bank of America's earnings, excluding their bond portfolio, was really good. Same with JP Morgan, same with Morgan Stanley, Charles Schwab, Goldman Sachs, BlackRock. These companies reported really, really good earnings. And that's why we're seeing this tailwind with financials. But overall, I think we're seeing better breadth come into the market. We're finally approaching that 5,000 level. The S&P 500, the level I've been talking about a while, and we're going to talk about that in the charts a little later. But the reason why the S&P 500 and the NASDAQ didn't do as well, the market cap weight indexes, is simply because technology, software, semis right here, and infrastructure just didn't participate in this rally. And when the big boys aren't participating right here, you're going to get a market that is not really going to move in the way you want it, despite, I think a lot of the other sectors doing really, really well. And let's have a look at it, right? Now, KRE, GDX, XLU, XLC, XLP, all the way down, right, have beat the SPY. The only stocks that underperformed the SPY was XLE marginally, XLI marginally, metals minings, and then we have discretionary software, technology, semiconductors. So pretty much the mega caps, right? Excluding Google and Meta here in XLC. So pretty much the mega caps and the major tech funds underperformed the SPY with XLE industrials and metals. That's it. Everything else did really, really well. So we are starting to see a little bit of a bid come into the market. Now, let's hop on the charts and let's talk about everything. So here we are on the charts, guys. So have a look at the major indices. So the S&P 500 down 0.22%, the NASDAQ 0.57%, but this is what's really interesting. The RSP, so, market breadth in terms of the overall market, the overall S&P 500, down only 0.09%. No after hours trade. Mid caps, very similar situation to the S&P 500, and then the S&P 600 actually gained ever so slightly. Very, very weird dynamic we've seen. Despite higher rates, these smaller cap companies have actually outperformed the S&P 500 at least this week in terms of price action. We actually see the IWM down 0.08%, but actually up the same amount in after hours. And then value was actually positive on the day, outperforming growth for the most part. And guys, look at this. We're seeing a little bit of upbeat action here in the RTY, as well as the S&P 500 in futures after hours. So I do think that the levels that we've traded to right now, this 5,000 level, is seeing quite a little bit of that early buy support we do want to see. At the same time, look at the VIX down 1.15%. And in the face of all the selling we've seen this week in the S&P 500, the VIX has actually come down from its highs very close to 20 to, the low 17 level. And if this continues to get crushed, that just means people are selling options, selling calls, selling puts, and that compresses volatility. It leads to positive gamma. If retail is selling calls, selling puts, that puts the gamma tape in a positive gamma environment. Now, something else we saw today was actually bonds did lose a hair ever so slightly. That means yields did bid up. And again, back to that small cap play, yields were actually up ever so slightly on the day. yet small caps outperformed and the market really just looked past those yield increases. So we have to start asking ourselves, how much is priced into stocks via the rise in yields? Is there a 5% 10-year? Have we priced that in? Is it a 4.7? Is it a 4.6? At what point do we start seeing yields up, stocks down versus the dynamic that we're seeing right now, which is, again, with the RSP, with the IWM, yields up, stocks sideways. So it does seem that whatever is priced into the rates market right now is sort of priced into stocks. Now, let's actually talk about our other proxies. Oil. We said we've been saying this for a couple of weeks now, that the $80 to $90 range is perfect for oil companies. And this is exactly probably where policymakers want it. And it's what's best for companies, especially companies like Oxy. You have $40 Permian break even, right? $80 oil, you are running to the bank. We look at the dollar. It did surge on the day, but coming down after yesterday. But still, you don't really want to see that move in the dollar at all. And then we look at something like gold, and this 2400 area continues to be quite big level of support right now. We still have this all-time high, but a very similar situation here. We hit this all-time high, it traded sideways for a while and then broke out. So do expect gold to trade sideways for a while before the next major move. That could be up or down, I don't know, but I'm just telling you what I see. And then Bitcoin right here, we just officially made a lower low on a closing basis yesterday in Bitcoin, but we did rally 3% here today. That being said, you do have to look at this. This is a downtrend, very volatile, and we did put a lower low. What Bitcoin really needs to do, probably go take some of these key levels right here. If it can do that, it can continue the uptrend. But let's actually hop on the S&P 500 and, have a look at everything. Now, guys, we do know, we've been saying this all week, between 5,000 and 4920 is this key level where we want to be buyers. And I do think we're seeing the right stuff from the right stocks and the right indexes to say this could possibly be the zone where we do actually, find a decent amount of support and go higher. I do think if we do break below the zone, things are going to get pretty ugly for markets. However, look at stuff like the VIX. Volatility is compressing in the last 3 to 4 days. Look at what IWM is doing. Look at the RSP today, okay? Look at these candles compared to these candles right here. And then look at some other technicals. Look at the 100 SMA. It's officially in our level of support that we've been wanting to buy for a couple of days now, a couple of weeks now, quite a few number of weeks. I said we're going to trade down to the 5,000 level right here after we made this high, after the massive NFP sell-off. So we could see tomorrow into OPEX, stocks trade down with the SMA rising a little bit, and then we find a bounce right there. Maybe we just bounce at the 5,000 level. And then we also look at something like the RSI getting very close to this oversold condition, especially in the daily chart. And that often does coincide with a great opportunity to buy, especially for the longer term. We go back, have a look at the last time we got to levels very close to where we are right now. This is the October low. We went on quite the rally. So I do think that there's a lot of things that are piling up that make this a very compelling buy opportunity to go ahead and hit new all-time highs here in the S&P 500. Now let's just clear these charts, right? So 5,000 is the buy level, 4920 to as low as that. Below it can get scary, but I don't think that's going to happen. I do think that right here, you do want to scale into buys. I am personally a buyer. I will be buying on the Australian market today, right after I make this video. So I am a buyer here, and I will continue buying all the way to the 4920 area. With all that being said, we do have to look at this objectively. That is a red bodied candle. We did finish in the lower half, the lower third of the candle. That is bearish. And if we hop on the 5-minute chart, you have to look at this and you have to say it definitely was a win for the bears. We did open up here, okay, trade lower, and then the bulls came in a big way, but they couldn't hold it, and we couldn't even break some key levels based off yesterday. Sure, we did go and make a higher high, I guess, but in the broad context of it, it's not really anything to write home about. And then we actually did trade lower, make a lower low at this 5,000 level. So a clear win to the bears. However, I do think there are favorable metrics coming into the market that make this a compelling buy opportunity. Another one is actually the ADL line, right? Let's zoom in, get really nuanced with it right here. So this is essentially, the ADL line is advancing issues minus declining issues divided by the actual price of the S&P 500. And generally speaking, you want this to trade with the S&P 500. If it's going higher, you want this to go higher. If the S&P 500 is going higher and this is going lower, that's a breadth divergence. You don't really want this. And we're starting to see a positive divergence. So we formed a top right here in the S&P 500, and then we traded lower in both the price and the ADL line. But then have a look at this section right here. I'm going to use this tool. So we make a low right here. Okay, we make a low, then we make another lower low in the S&P 500, right? Then we make another lower low right here in the S&P 500, and we actually make a high in the ADL line. So more issues actually moved higher yesterday. And then as we make another lower low, right, we do put in a low, but it's an equal low to what we did on Tuesday. So the S&P 500 moved lower than what it was on Tuesday, but we actually put in an equal low here in the ADL line. That's a positive divergence. Now, it's very, very nuanced. It's very, very slight. However, you can't deny the fact that divergence is there and more issues are advancing. And we can definitely see this with price. Look at the RSP versus the S&P 500 and the price action they put up. And we can definitely say that, yes, the underlying strength of the index, although not the big hitters, the market as a whole is moving in the right direction. And that's actually what you want to see when you get to critical levels here, like the 5,000 level. You want to see this type of stuff. And it's often a very early indication, a leading indicator that we are going to get a bounce. The thing is, once we get that bounce, we then have to go take some very, very key levels for continuation of the uptrend. And that's the next thing we want to do. We want to find support right here, bounce, and then once we make this bounce, it's time to go break key levels, highs, to confirm the uptrend. Now we got the AA sentiment survey, the latest survey, and guys, things are moderating in a very big way. Bullish sentiment vote stands at 38.3%, so still fairly elevated. I do believe the historical average is very close to 37%. Neutral at about 27.8%, and this is the massive change from a 24% where we stayed very, very muted for the last 3 weeks. We've actually seen a big uptick in bearish sentiment votes, and this probably has truly marked a change in the sentiment of the market. And I think we will see a second change when we see bearish sentiment votes bigger than bullish sentiment votes, and that could very well happen next week, especially if the price action continues as it is right now. But looking at this note from BofA, April 22 to March 23 marked 12 consecutive months of negative year-over-year returns for the S&P 500. April 2023 broke this bearish streak with a positive year-over-year return. We view this as a bullish backdrop signal for US equities, and the SPX, the S&P 500, has rallied 20% since. March 24 marked 12 consecutive months with positive year-over-year returns for the S&P 500. This is also a bullish backdrop signal. The threshold for solid positive S&P 500 returns is continuing the signal for at least 12 months. The average stretch of 20 months positive year-over-year returns show the S&P 500 up 17.1%. That would mean 6150 into November 2025. The median streak, 17 months, shows the S&P 500 up 14.4%, 6,000 into August 2025. And here are the data points. And essentially, this is where we are right now. When the streak started, 12 months later, the current move in the S&P 500, 8.5%. And essentially, based on the average, based on the mean, that would take us to a 17% average move in the S&P 500, 14.4% average move. And the return figures 6150, 6,000 right here. So all in all, very bullish stats, as you can see. And essentially, momentum brings momentum, and any pullback we do get in this market should just be looked as a dip buying opportunity, because it's very likely we're going higher. There's plenty of long-term breadth measures, breadth indicators, and technicals that are pointing to just higher price action despite the prevailing sentiment. Now, this is a price return analog based on past price action, but what about forward returns based on major macro events? And I have the data right here. This is the S&P 500 when the 10-year yield crosses 5% and the expected forward returns. So right now, the yield of the 10-year is sitting at about 4.5%. So still a while away from hitting that 5% figure. That being said, the momentum and risk is to the upside in bonds, especially with a stronger economy, especially with higher inflation. So it is good to look at return analogs like these. And we can see that it's not very positive at all. Normally when the 10-year crosses 5%, 3-month returns is negative 1.8%. Forward 6-month returns normally 5.8%. Against all other periods, you could see here that it's normally positive. So higher rates, not really good for S&P 500 large cap stocks at all. This is data since 1978. We can see the very same thing here with the Russell 2000. Forward 3-month returns is a smidge positive, call it pretty much flat, especially for a 3-month period. And then 6-month returns tend to be negative 4.1%. So small caps, large caps, Russell 2000 is small caps, micro caps, not very positive at all. And at the end of the day, like Warren Buffett said, interest rates are like gravity. The higher they are, the more it's going to weigh on stocks and the broader economy. Now let's talk earnings. We got two very big names reported today. TSM before the open right here, and then Netflix after the close. We are going to look at both of them. Now, Taiwan Semiconductor Manufacturing Company earnings, that's a mouthful of a name, reported very good earnings. They beat on revenue, beat on net income, beat on EPS. The lower end of guidance beat the street's guidance forecast. Very, very good earnings. In the earnings call, they said they now see auto chip demand to drop this year. Growth forecast at 10%, prior was over 10%. Another note in their earnings report was semi demand for IoT and industrial applications remains sluggish, but they did say insatiable AI related demand for energy efficient computing power. So a lot of their earnings right now is being driven by data center revenues and this AI mega trend. Now, this segment is recorded before earnings for TSMC, and I think when I looked at the price, they were down like 2% at the time. I think they had a small pop and then they came down pre-market. However, results may change after the market close hours. Now, when you look at the headline figures, earnings is actually good, guidance was good, revenue, earnings per share was good. The reason why the stock was muted or down in pre-market trade was simply because of these metrics right here. Gross margin 53% and then operating margin 42%. That's a 3 percentage point decrease year over year on both figures, gross margin, operating margin. So even though we had revenue up, EPS up, net income up, all ticks in my book, as well as guidance on the upper end, the monies that shareholders will be able to take home in free cash flow per share is 100% going to be less, simply because the metrics down the income statement, down the free cash flow statement, are slightly worse than what they were last year on a percentage comparable basis. And contracting margins simply showcase operational inefficiencies, and that's something that the street doesn't really like. They want to see margins staying the same or expanding. Contracting margins is the early signs of a red flag in a company. Now, TSM's a great company. I'm not saying there's any red flags. I'm just saying that the reason why we had such a muted pre-market on what is great earnings comparatively had to do with the margin situation, gross margins, operating margins. Netflix earnings, guys, great earnings, fantastic earnings, right? Beat on revenue, beat on subscribers by 5 million. Market was expecting 4. Netflix got 9.33 million, crazy. On EPS, 5.28 versus 4.52. Their guidance also beat. Netflix, Wall Street were expecting 4.27. Guidance came in at 4.68 for Q2. Q2 revenues beat as well, 9.5 billion against 8.9 billion. However, Netflix did trade down 3 to 4% in after hours because of this. They're not disclosing subscriber numbers anymore to shareholders. And this is a major red flag. It pretty much means that subscriber growth is going to slow. What it's signaling to the market. We saw the exact same thing with Microsoft. We saw the exact same thing with Apple, and they stopped disclosing iPhone numbers. When you see stuff like this, huge red flag to shareholders. Even though guidance is pretty good, this indicates what's the longer term trajectory of Netflix and how much more subscribers can they add onto their already, 270 million plus subscribers. So it does look like the majority of their growth is probably going to come from their ads platform price increases in the future. Now, this is not saying this quarter or next quarter. This is more of a longer term, years down the track situation. I do think that Netflix are probably going to grow subscribers next year, the year after next. It's just that growth is going to start to decelerate, and that's why they stopped disclosing it. Other than that, we look at the actual figures. This was a fantastic number, a huge beat with subscribers, revenue well to the upside right here, and I think this was fantastic earnings. It's just that what it was signaling to the market wasn't quite what Wall Street wanted, hence the sell-off after hours. Now we got some forecasts from Goldman. This is just Goldman's investment research, and essentially this right here shows us what GDP is going to do into 2024, 2025. And Goldman actually expect GDP to moderate. However, it is still very elevated, well above the 3% mark on the left, as you can see right here. So it looks like growth is going to stay anywhere between 2 to 3%, but definitely on the upper end of that target range. At the same time, GDI has accelerated here in 2023 all the way into 2024, and the US current activity indicator still remains very elevated. What is this data telling us? Activity growth remains pretty solid. The economy is in good shape on a growth forecast level, while inflation continues to moderate. Yes, we have had some pretty rough inflation prints, but at the end of the day, we are still in a disinflationary environment. Inflation is decelerating year over year, quarter over quarter, and both will continue to expect disinflation towards the 2% target here in PCE, both headline and core, into 2024 and 2025. Now, while this is going on, both is forecasts for expected projected Fed funds is actually 3 cuts in 2024, and they expect 1 cut every single quarter starting in July. This is where the current Fed funds is, just below this 5.5 area. This is January 2025. You can see that it's just below this 5 mark, and that would represent 3 25 basis point cuts from 5.5 to 5.25 to 5 to 4.75, and that would take the federal funds rate to about 4.5, the target range to 4.75. That would be 3 cuts against what the market is currently pricing in, which is just 2 cuts, and I think the first cut being in September. So Goldman do have a more dovish stance on market Fed pricing. I guess maybe they have access to more data and they're seeing things the market doesn't see. Maybe they're just signaling to the Fed, but this is their forecast for the most part, and they are expecting 3 cuts every single quarter starting in July. Let's talk gamma, guys. So we're approaching OPEX. OPEX is on Friday, and we can see a couple of very crazy things. Number one, the put support is here at 5,000, which means that's probably going to be the place where we do find support if we do get to this 5,000 level. I don't think we're going to go much below it. We could probably go to like 49.50, maybe as low as 49.20, but we should really find a very, very strong support at these levels here at 5,000, especially into this OPEX period. Positive gamma still remains very, very weak, all things considered, and there's a ton of negative gamma in the tape, with 51.65 being the gamma flip zone. Be prepared for elevated volatility to the upside and the downside. After OPEX and into the window of weakness, what we really want to look for is once all of this gamma is rolled off, where does the put support strike reposition itself? Does it go lower or does it go higher? And where does the call gamma resistance reposition itself? Previously, it was at 5,300. You want to know something crazy? Look at the call resistance right now at 5,400. It actually moved further up the strike with the put support staying where it is. That's often a bullish sign, and I do think that we're probably going to bounce here at the 5,000 level, find strong support, maybe have price discovery for a couple of days, and then probably rally into this 51.65 area, 5100 area. That's at least what I'm predicting into the window of weakness, because that's how it works. If we're in negative gamma, we normally sell into OPEX and then it's a tailwind. If we're in positive gamma, it's sort of the opposite, where we'll rally into OPEX and then enter the window of weakness, where these dealer supportive flows or these dealer hedging flows, which hedge with the trend in negative gamma, they're not as strong leading up into the new month into OPEX. Now guys, sometimes when the market just goes absolutely parabolic, we can actually forget the fact that we can have pullbacks. And I want to point something very interesting out right here. Look at April seasonality. Actually, it's negative 0.01. You could say it's pretty much flat, but what you really want to look at is actually the hit rate. See, this is the percentage of the time the month is up. 58% of the time, April actually gains, which means 42% of the time, April actually loses. So to finish just negative in totality since 1928, where 58% of the years are up, that means the negative years that account for only 40% of the time period or 42% of the time period have to be very negative. Essentially, what this tells us right here is that April can actually be quite a negative period if you do understand seasonality and if you do dive deeper into it. So a negative April and even a negative May, as you can see right here, is actually 100% normal. The volatility we're seeing right now is actually part of a typical election year, and it should just be looked as opportunities to buy the dip, because here in June, July, August, pretty much for the rest of the year, by these 2 months right here, we actually get very favorable seasonals to the upside. And like I always say, momentum brings momentum. Guys, it's that time of the week again when we look at BOFA's charts. The reason why we look at these charts is because 78% of fund managers have access to BOFA's research. So you know the big boys, the big money, the fund managers, asset managers, hedge funds, they're all looking at these charts, even if they just glance over it. And it is a little bit of an edge that you will have over the rest of the market who don't look at these. Now, S&P 500 weekly charts with moving average. We are bullish. We are above the 200 moving average here. And pretty much BOFA say the SPX has achieved the measured move to the 5,000 area on the cup and handle breakout right here. So you take a measured move up to the 5,200 area. Given weaker presidential election year April and May seasonality, the 5,200 could mark a pause prior to a June, August summer rally towards the 5,600 area. Key supports 5,000, 4,800, 46. So pretty much they're saying, yep, we're seeing a bit of volatility, a bit of a pause here. We could pull back to 4,800 to possibly as low as 46.37 before we then begin the ascent to the next upside target of 4,600 here towards the end of December, which would be wild. Imagine if you were to get a pullback here to the 4800 area and then buy, looking for the 5600 and above. Very bullish here. Looking at the Nasdaq 100, it broke out from a bullish cup and handle similar to the S&P 500 in December 2023 and went on to new all-time highs in January. These breakouts suggest upside to 19,500 measured move, 2,100, 21,200 cup and handle count, and 23,000 projection for the move to new all-time highs. The risk is for an April into May pause ahead of these levels. Prior resistance at the breakout points offer support at 17,000, 16,600, and then 16,000 to 15,695. Very similar situation to the S&P 500, except we haven't got the first measured move, but both see somewhat of a pause here at the 18,000 level, pull back to possibly as low as the 16,000 area right here before we do rocket up to the 1915 area, and we could go as high as 21,000, 23,000 in the Nasdaq 100. Looking at the Russell 2000 ETF, it continues to struggle with the 208, 212 area, this area right here. Regaining this area is important for confirmation of a big base for small caps. Losing first support on IWM at 200 to 199 places the focus on the rising 200 week and 40 week moving averages here, 193 to 190, and chart support at 190 to 187. So pretty much this is a very crucial area. And also in August, I said that the IWM right here, I said small caps are going to break out. The target was actually 212. That's what I said last year, August. I'll put the tweet up on the screen. And now both see a very similar situation. So they're ripping my content. We know that for a fact. And essentially what they're saying is if this 200 area support doesn't hold, we could see confirmation with these moving averages right here for upside targets of 234, 244, 250 plus if we can go ahead and retake the 208 area. But there's a lot of dynamics here in play with small caps, and one of them is earnings as well as the macro environment. We really do need to see a pickup in earnings for small caps if small caps do want to break above these levels and go higher to new all-time highs. Now looking at market breadth, the NYSE composite and NYSE stocks advanced decline line, that's the bottom chart right here. Breadth has taken a hit since late March as the US equity markets navigate the weaker months of April and May during the presidential election year with a big drop on the NYSE ADL line. The NYSE shows support in 17,400, 16,900, 16,400. So pretty much breadth has come down in a very big way, as you can see right here, after making this new high, and we are finding support at this 29,907 level in the ADL line. What that means on the chart is that we should find support at 17,400. If we go lower, 69 and then 16.4 on the way down here for the New York Stock Exchange. So those will be critical support zones. I think below here it does get a bit ugly, but I don't see that happening. Just look at this. This is bullish, okay? This is bullish. Looking at market breadth for the S&P 500. So this is the S&P 500 right here, and percentage of stocks above the 50-day moving average. The percentage of S&P 500 stocks above their 50 moving day year to date has had a negative divergence and has broken below support. This indicator is not yet oversold. So even though breadth is diverging, the indicator is not quite oversold yet, which means one simple thing: more downside for the S&P 500 because more stocks are going to move lower, and we normally do get to this level right here. And for the S&P 500, that could mean support to as low as 48.21, 46.84, and 45.47, or maybe in line with this moving average right here. Now this is the S&P 500, okay, at the top right here, and percentage of S&P 500 stocks above their 10-day moving average. Very similar chart, and we are current in this oversold section right here, below 10%, which means we could see an intermediate term bounce with support possibly in the 5,000 area. So we hit this 5,000 area, offer support, and then this should shoot up. And then from there, we'll assess the situation. Now, this is the US 2-year yield chart. Both say an ascending triangle pattern was confirmed with the breakout above 4.75%. This implies a move higher can persist into the second quarter at 5.13 and 5.25. That is nuts. And possibly a new cycle high of 5.3 to 5.4% here in the 2-year yield. So kind of crazy. We have just been moving up in the 2-year yield, and both see possible cycle high, very close to this red line right here, potentially this green line right here. And this has actually been confirmed by these indicators, the RSI as well as the MACD. They do look postured for more bullish upside. Now looking at the US 10-year yield, favorable uptrend signals include the 50 daily SMA crossing above the 200 daily SMA, a golden cross, the MACD widening, a head and shoulders continuation pattern, and update wave count. A TD sequential 13 signal suggests yield completes wave 3 around 4.67%. Merging that with our wave count, it says yields dip into a wave 4. After this, we can see a wave 5 up complete by Memorial Day and consider longs into the 470 to 5% area. As wave B in the weekly chart completes yield support at 4.5, 4.3, 4.24, 4.124, and 4% as a whole. Resistance at these levels. Pretty much what Bofa is saying is this right here. We should see a little bit of resistance before they continue into the fifth leg of the wave, getting to possibly as high as 5%, 5.02% here in the 10-year yield. At the same time, we're seeing again favorable MACD and RSI technicals pointing to more bullish momentum but short-term weakness. But if you've made it up until here, thank you so much for watching. Guys, if you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.